By 1945, the landscape of American business had changed. The Second World War had just ended, and the economy, well, it was poised for a massive transformation. With military production finally dwindling down, millions of people returning home, and the emergence of new technologies, the country was fertile ground for innovation and exploration. No longer did people have to worry about survival. Instead, they could live. They could take life by the scruff of the neck and truly begin to set out on what many consider today the American dream. But we'll get onto that later. See, human beings are unique. Unlike other animals, we follow complex patterns that guide the way we talk, act, think, and interact. Now, while these historically have been used for both good and bad, it allows us to do something particularly interesting: dream. It allows us to set goals and act on them. It drives the fire inside us, push through and work relentlessly until we achieve what we set out to do. Why am I talking about this though? Well, to put it simply, that's the basis of venture capital. As people seek to turn their visions into reality, venture capital has emerged as a means to support bold ideas and groundbreaking technologies, transforming aspirations into tangible successes. This is the history of venture capital. Chapter 1. The early days. In the wake of the Second World War, America stood on the brink of a new era, one ripe with potential for innovation and growth. Amid such a backdrop of opportunity, four figures emerged as pivotal players: Carl Compton, Merrill Griswold, Ralph Flanders, and General George F. Doriot. Making up what became known as the ARDC, the American Research and Development Corporation, in 1946, these four men, all of whom had already achieved success in corporate America, had a vision. If they could successfully leverage the mostly untouched capabilities of new technologies that had been created during the Second World War, they could essentially revolutionize the way business would be operated in the country. Let me explain. At the time, things were different. If you had a good idea and were serious about starting your own business, the road to success was pretty difficult. People weren't as open back then. The idea of risk, well, it wasn't appealing. What may be considered a good idea now, back then, probably wasn't. I mean, even if you did manage to break through the societal limitations that existed, if you wanted to find any sort of decent funding for your operation, you had to rely on banks or established corporations, both of whom were considered totally risk-averse. Entrepreneurs simply faced huge barriers, but at the RDC, things seemed to be changing. The four men had a plan. They were to raise capital using sources that weren't connected to major families and use them to privately invest in companies, making the most of the new groundbreaking wartime technologies. At the start though, things were slow. The initial investments were modest and the market was still hesitant to embrace the potential of new technologies. It wasn't until 1957 that things really started to take off. See, earlier that year, Ken Olsen and Harlan Anderson, two researchers at MIT, had an idea. Noticing that students at the university would wait hours to use fairly run-down TXO computing systems, something felt off to them. I mean, more advanced models were available and at the disposal of students. Why didn't they just use those? Well, as they say, beauty is in the eye of the beholder. Despite running smoother and having far better performance outputs, newer models were not able to achieve the same level of graphical output as the TXO. There was a gap in the market, and Olsen and Anderson became hell-bent on creating something that could pair the advanced mechanics of newer models with the traditional usability of the TXO. If they were able to create a smaller machine that retained all the essential functionalities of a standard TXO, there was success to be had. But as you may expect, not everything would go smoothly for the two. Fairly quickly, they ran into a major problem: funding. At the time, no one wanted to invest in computers. By this point, thousands of companies had come and gone. Even the biggest computing corporations out there weren't making any turnover. It was a barren industry, increasingly becoming reorganized as new technical developers came in. But one company held out hope for Ken and Harlan, the ARDC. Finding their proposal interesting, George Doriot, one of the founders of the company and a man who today is credited as the father of venture capital, told them to readjust. Noting the deficiencies associated with the industry, Doriot told the two to become more flexible in their focus and make changes to their business plan. Offering an investment of $70,000 for a 77% share in the company, things would begin to boom. Only 14 years later, the company's value had shot up to $355 million. The progress was there to be seen. Finally, the ARDC managed to show that venture capital wasn't just a theory, it was a viable business model and a sector with real money to be made. Chapter 2. Liftoff. Seeing the success of the ARDC, by the late 1950s and the early 1960s, it's fair to say that venture capital had arrived. With its reputation changing to that of an actually viable way to make some serious money, things really started taking off. From proteges of the 4 ARDC founders creating their own companies to even early government action such as the passing of the Small Business Investment Act in 1958, the path was paved for private equity firms to thrive. To put it simply, there was a pretty obvious, successful blueprint to follow. Take Arthur Rock, for example. Once a student of Doriot, the man, along with 7 others, managed to create a firm that would eventually become Davis and Rock. You know, the guys who, in the future, would invest in companies like Apple and Intel. Something changed in the 1960s and 70s though. Venture capital took on a new lease of life. While the ARDC's blueprint of investing in existing companies was working, and in all senses of meaning had found its place in greater society, VC firms were now starting to aid in the creation and early expansion of companies. With the change nearly immediately linking the concept to the idea of technology finance by aiding a company in its infancy, venture capitalists could benefit from the exponential growth potential of emerging technologies. No longer did they need to rely on the slow traditional paths of investment in established businesses. Rather, in a weird way, they could actually sculpt the trajectory at which promising businesses operated. From software innovations to biotechnology breakthroughs, venture capital was taking over the entrepreneurial ecosystem and fueling innovation like never before. By 1973, firms were only getting stronger. The National Venture Capital Association was created, money was rolling in, and its success became impossible to argue against. Soon enough, venture capital would experience its first real boom, with the number of firms operating in the industry rising from a few dozen to nearly 700 by the end of the decade. By the end of the decade, everything had changed. But that wasn't all. See, the 90s is when things became really interesting. Why? Well, the internet. Chapter 3, Up and Down. You know what they say, where there's smoke, there's fire. And what felt like the gradual ascent of technological innovation over the last few decades came to a head during the 1990s. The internet was here, and with it came the birth of the dot-com boom. From the creations of Google, Amazon, Netflix, PayPal, and so much more, the 90s were a venture capitalist dream. The opportunities created by the internet age were tremendous. From 1991 to the year 2000, the amount invested into technology rose by nearly 90 billion. Overnight, investors were becoming multi-millionaires. It was a real-life frenzy. As is often the case, unfortunately, good times don't last forever. The dot-com bubble was about to burst, and the VCs that joined the bandwagon were in for a rude awakening. See, spending became volatile, companies were overvalued, competition was increasing, and there seemed to be an overriding fear that the year 2000 would leave old technologies behind, causing waves of issues that extended not only to the greater economy, but also to the business models of big companies. The repercussions were profound. By 2002, stocks had lost 5 trillion since the peak years, and layoffs, liquidations, and massive sell-offs became common. The bad times wouldn't last for long though. As the dust settled for the dot-com bubble's burst, the landscape of technology and investment would change forever. Companies had learned their lessons, and a restructuring was about to emerge. It turned out the internet wasn't just a passing fad, it was the foundation of something huge, something that had the potential to redefine the way we connect, work, and live. Chapter 4. The Golden Age. The aftermath of the dot-com bust was interesting. In a way, it could be argued that venture capital actually returned to its roots. A newfound focus was placed on expanding the value brought to firms beyond capital, and investors started to examine the portfolios of companies. More due diligence was being done, and venture capitalists acted according to the specific phases of a company's development. The key to lasting success wasn't in rapid growth, it was creating real value for customers and building enduring companies. This ushered in the Golden Age, a time which saw entrepreneurs emerging into the mainstream of media, and companies were rewarded for their commitment to innovation and sustainability. Take Facebook as an example. Founded in 2004, only a few years after the dot-com bust, the company not only had a revolutionary plan to change social networking, but also demonstrated the sheer importance of building strong foundations. Initial funding came from Peter Thiel, the founder of PayPal, in 2004. It wasn't just the 500,000 that allowed Facebook to succeed though. I mean, sure, it helped. It helped expand infrastructure and enhance user experience, but Thiel and later other investors made sure to provide mentorship and strategic advice to Mark Zuckerberg, reminding the young entrepreneur that it wasn't all about making money at this point. The strength and stability of decision-making in the post-dot-com era would actually point for firms, just like Facebook, to staggering levels of success in the future. Airbnb, Spotify, LinkedIn, Zoom, the list goes on and on. While the dot-com bust may not have been a blessing in disguise, it sure set venture capitalists on a path path that was denoted by increased caution and smarter investment strategies. When pairing that with the newly emerging idea of tech accelerators, such as YC, the startup ecosystem began to flourish in ways previously unimagined, providing entrepreneurs with not only funding, but also mentorship, resources, and networks to help them succeed. These accelerators played a crucial role in nurturing early-stage companies, allowing them to refine their business models and scale effectively. Today, venture capital stands at a pivotal point in its history. Technology has perhaps never been so integrated into daily life, and evolutions in its form are appearing more significant by the day. Marked by the development of AI and blockchain technologies, venture capital is continuing to adapt to changes in the contemporary world. But with that, it faces new difficulties. In the modern day landscape, investors face challenges unseen before, from ethical considerations to regulatory uncertainties and futile speculation. The path forward requires a careful balance of innovation and responsibility. Whether that can be achieved, only the future will tell. If you like this video, please subscribe. I'm doing a lot more videos on sports and business.